Hello, this is Japanese Economic Review Channel. Welcome to the FY 2026 Q2 briefing. Today we will explore the underlying structural shifts in Japanese enterprises. We will focus on sentiment shifts, chronic labor shortages, and aggressive capital allocation trends. Let's dive into the data to understand the real corporate playbook. Here is our executive summary. We observe a temporary dip in Q2 sentiment, but a strong rebound is expected. A revenue-profit paradox is emerging due to rising costs. Driven by 60 quarters of labor shortages, companies are deploying aggressive capex to automate and survive. Looking at large enterprises, the Q2 BSI dipped by minus 0.5%, the first drop in 4 quarters. However, this is just a temporary pause. Forecasts show a robust V-shaped recovery to plus 4.3% in Q3 and plus 4.5% in Q4. The short-term pessimism shouldn't overshadow the strong recovery trend. What is driving this sentiment? The automation wave is boosting Infocom tech manufacturing, plus 9.3, and production machinery, plus 7.8. Conversely, auto manufacturing, minus 19.4, and construction, minus 10.9, are dragging down the index, heavily impacted by cost and labor pressures. The domestic economic outlook mirrors corporate sentiment. Large enterprises show a slow recovery, minus 4.5%, expected to turn positive in Q4. Meanwhile, small enterprises forecast sustained negative conditions, minus 28.2%. This highlights a growing resilience gap between company sizes. This is Japan's most critical issue, the chronic labor shortage. We have hit 60 consecutive quarters of insufficient labor since 2011. The deficit is severe across all scales, with large enterprises at plus 5.7 points. This is no longer cyclical. It is a permanent structural constraint. This brings us to the revenue-profit paradox. While FY 2026 revenues are forecasted to grow by plus 3.3%, ordinary profits are expected to drop by minus 2.4%. Companies are selling more, but chronic operational constraints and input costs are severely squeezing profit margins. Who is navigating this squeeze successfully? Textiles, plus 2.1%, and finance and insurance, plus 6.0%, are seeing high profit growth. However, non-auto transport equipment, minus 31.4%, and non-ferrous metals, minus 22.2%, are suffering. Cost control capabilities are creating clear winners and losers. Following the labor trend, physical production capacity is also running at a deficit. Large enterprises report a plus 3.8% insufficiency. Small enterprises feel the most acute bottleneck at plus 10.4%. Businesses are running out of both human and physical resources to meet demand. To buy their way out of this productivity trap, companies are investing aggressively. Total capex is forecasted to surge by plus 8.2% in FY 2026. The manufacturing sector is leading this charge with a plus 10.1% planned growth, signaling a massive pivot towards automation. Where is this capex going? We see a massive boom in utilities, plus 39.3% for infrastructure upgrades, and Infocom machinery, plus 29.8% to power the automation wave. Meanwhile, agriculture, minus 16.0%, is cutting investments. The focus is entirely on tech-driven efficiency. Investment strategies reveal a tale of two approaches. Large caps prioritize maintenance, 63.7%, and labor saving, 43.9%, to automate their footprint. In contrast, small enterprises are forced to prioritize capacity expansion, 52.0%, to build out their physical limits. The funding divide is equally stark. Large enterprises rely heavily on their own balance sheets, with internal funds being the top source, 69.6%. Small enterprises, however, are highly dependent on external leverage via private banks, 73.6%, making them vulnerable to interest rates. In conclusion, 60 quarters of structural labor constraints lead to a margin squeeze. The answer is an aggressive plus 8.2% capex surge. Japanese enterprises are actively investing to overcome demographic traps. Do not be distracted by short-term dips. Focus on this massive structural investment cycle. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.